Digital Realty Q1 2026, a massive beat across the board, and management just bumped their full-year outlook. Total revenue came in at $1.6 billion.
Which is a solid 16% jump year over year.
Right. And net income available to common stockholders hit $169 million, so that's 46 cents a share.
Up pretty sharply from 27 cents in the same quarter last year.
Exactly. Core FFO reached 2.04 per share, and on the strength of that, they bumped 2026 core FFO guidance up to a range of 8.00 to 8.0. And the stock is up about 3.5% on the open.
Yeah, it's a phenomenal financial snapshot. I mean, you are looking at double-digit growth driven by just an unprecedented wave of demand, paired with some really disciplined capital management.
So look, if you're joining us for this deep dive, every single time you ask a generative AI tool to draft a proposal or, stream a 4K movie, there is a physical building somewhere consuming vast amounts of electricity to power that action. And today, we are analyzing a massive stack of Q1 earnings materials from Digital Realty. So we've got their financial presentation, the Form 10Q SEC filing, the earnings release. Our mission is to look past those headline numbers we just gave you and understand the actual mechanics of how this company funds and builds the physical backbone of the digital economy.
Because the timing for this is just perfect.
Yeah.
The digital realm often feels completely invisible to us, right?
Yeah, totally weightless.
Right, weightless.
Yeah.
But right now, that weightless world is colliding with the heaviest, most physical constraints imaginable. Steel, concrete, land, raw electrical power.
So to understand those physical constraints, we first have to look at the sheer volume of demand flowing into their pipeline right now. I'm looking at their bookings, and it seems almost historic. Can you put the Q1 demand into context?
Yeah, it's absolutely eclipsing historical norms. In just this first quarter, they signed total bookings expected to generate $707 million of annualized GAAP rental revenue. And that's at 100% share. If you isolate just Digital Realty's specific ownership share, it still sits at an immense $423 million.
Okay, but the metric that caught my eye in the 10Q was the backlog. They reported a total backlog of signed but not commenced leases sitting at $1.8 billion.
Yeah.
Wait, so signed but not commenced, meaning the ink is dry on the contract, but the tenant hasn't actually moved in or started paying rent yet.
Precisely. And the earnings materials highlight a weighted average lag of 19 months between the day a new lease is signed and its commencement date.
19 months. I have to frame that for the listener because in the tech sector, a year and a half is an absolute eternity.
Oh, it's a lifetime.
Right. We've seen entirely new iterations of AI models disrupt industries in a matter of weeks. This isn't like renting an apartment where you just, hand over a deposit and move in on the first of the month.
Not at all.
You are essentially commissioning a custom digital skyscraper. By the time that facility is built, the servers are racked, and the revenue actually hits the income statement, the entire tech landscape could look completely different. Doesn't waiting 19 months for cash flow introduce just a dangerous level of risk?
It sounds counterintuitive, I know, but in commercial real estate at this scale, that 19-month lag is actually one of their greatest structural strengths.
Really? How so?
That $1.8 billion backlog isn't a vulnerability. It acts as a highly effective financial shock absorber.
Walk me through the mechanics of that. How is waiting a year and a half for rent a shock absorber?
Because it guarantees an ironclad pipeline of future revenue. The filings note that this specific backlog represents 23% of their current in-place annualized rent.
Okay.
So think about the visibility that provides management. Before they even wake up on January 1st of next year, they already know that nearly a quarter of their future revenue base is legally locked in by contract.
Oh, wow. I see.
Right. The tech companies, they're tenants. They have to worry about which AI model wins the market or how consumer behavior shifts over 19 months. Digital Realty does not.
Because they're just renting the space.
Exactly. They aren't betting on which software wins the race. They own the physical racetrack where all the models have to run.
So they're completely decoupled from the software risks.
Yes, and this multi-year visibility shields them from short-term macro volatility. If the broader economy dips into a recession next quarter, Digital Realty is largely insulated because their growth for the next year and a half is already contractually obligated.
That structural visibility makes a lot of sense. So knowing how vast this pipeline is naturally leads to the question of who is actually renting all this space.
Right. Who are the tenants?
Yeah, and reading through the breakdown, I noticed two very distinct categories of tenants driving the revenue. It sort of looks like an ecosystem of whales in a reef.
Yeah. That's a great way to put it. Let's define the whales first, because they are consuming the vast majority of the oxygen right now.
Okay, so the whales are the hyperscale clients. Deployments requiring greater than 1 megawatt of power. In Q1, this category accounted for 77% of their total bookings by volume.
Which is massive.
It is, and the report specifically highlighted that they just signed the single largest hyperscale lease in company history, catering directly to AI-oriented capacity. What does a deployment like that actually look like on the ground?
Well, when you hear AI-oriented capacity, you have to picture something far beyond your traditional server room.
Yeah.
These hyperscale deployments involve sprawling, incredibly dense clusters of computing power.
Because the chips run so hot, right?
Exactly.
Yeah.
They require specialized liquid cooling infrastructure. They need reinforced flooring to handle the sheer physical weight of the hardware, and dedicated substations just to route enough electricity into the building. The whales take up colossal footprints.
But right alongside those massive hyperscale builds, management spent a surprising amount of time on the earnings call highlighting a much smaller category, the reef.
Yeah, the 0 to 1 megawatt segment.
Right, which includes interconnection services. And the data there is pretty impressive, too.
It really is. They reported a record $98 million in bookings from this 0 to 1 megawatt category, which represents 42% year-over-year growth.
And they added 116 new logos.
Yep, 116 brand new corporate customers in Q1 alone.
But here's what I don't quite understand about the strategy.
Okay.
If 77% of the volume is coming from the giant hyperscale leases, why is management bragging so much about the 0 to 1 megawatt segment? Why celebrate 98 million when the hyperscalers just handed you over 300 million? It feels like a drop in the bucket.
It's all about the underlying unit economics. It comes down to pricing power. Those hyperscale whales, the major cloud providers, they know exactly how much leverage they possess.
Sure, they're bringing hundreds of millions to the table.
Right. When you bring that much cash for a 50-megawatt campus, you bring aggressive procurement teams that will relentlessly grind down the profit margins. They demand wholesale discounts because they're buying in such extreme bulk.
Right. Okay, so top-line revenue is huge, but margins are thin. How does the REEF operate differently?
The smaller customers, like financial institutions, content delivery networks, regional enterprises, they create a sticky, highly interdependent ecosystem.
What do you mean by interdependent?
When an enterprise moves a few racks of servers into a digital realty facility, they aren't just renting physical floor space. They're renting proximity to other businesses. They physically run fiber optic cables, which are known as cross-connects, directly from their servers into their partner servers down the hall.
Wait, so they bypass the public internet entirely?
Precisely. It creates a closed-loop network with virtually zero latency.
Oh, wow.
And once a company wires its architecture into that physical ecosystem, the switching costs to leave become astronomical. You can't just unplug and move to a cheaper data center across the street without severely disrupting your operations.
Right, because you'd lose all those direct connections.
Exactly. Because of that extreme stickiness, Digital Realty commands significant pricing power over the reef.
Yeah.
We can see the definitive proof of this in their renewal data.
I have that data right here, actually. So they signed renewals representing $193 million of annualized cash rental revenue. The rates on those renewals increased by 5.0% on a cash basis and 6.3% on a GAAP basis.
And here's the crucial detail. 81% of those highly profitable renewals occurred in the 0 to 1 megawatt category. Only 17% were in the greater than 1 megawatt category. The hyperscalers pay for the sheer scale of the buildings, but the interconnected reef is where Digital Realty actually flexes its pricing power, drives up margins, and creates long-term stability.
Which is how they achieved that $2.04 in core FFO.
Exactly.
Which, just for the listener, core FFO is simply a real estate metric that strips out non-cash depreciation to show us the actual cash the business is generating.
Right. It's the truest measure of their cash flow.
So, to support that highly profitable reef and fulfill the $1.8 billion backlog of hyperscale leases, they need space. And their pipeline says they basically need to more than double their global footprint. Let's look at the sheer physics of that.
The physical expansion is almost difficult to conceptualize. They currently operate about 3 gigawatts of in-place IT capacity globally. but their future development capacity is mapped out at over 5 gigawatts.
Which really explains the aggressive land grab we saw this quarter. I mean, in Q1, they acquired an 873-acre parcel in Atlanta for $95 million, which they expect will eventually support over 1 gigawatt of IT capacity.
Just massive.
They also bought a 30-acre parcel in Portland for $50 million, supporting 160 megawatts. But reading the 10Q, the Atlanta acquisition just stands out. Buying 873 acres is like annexing a small town just to house servers.
Yeah, it really is.
It feels like playing Monopoly, but instead of buying Boardwalk to build a hotel, you're buying a massive tract of land solely to secure the rights to the local power grid.
That is exactly what it is. The power grid is the absolute limiting factor for this entire industry. In the AI era, real estate is completely useless if you cannot illuminate it.
Right.
When they buy 873 acres in Atlanta, that's not a traditional real estate play. It's a strategic power grab. You can't just build a 1 gigawatt campus and ask the utility company to plug it in tomorrow.
You'd blow the grid.
Exactly.
Yeah.
You have to secure the land years in advance just to reserve your place in line for the regional power grid's future transmission capacity.
And they're executing this far beyond the U.S., too. The Q1 filings show they acquired Telepoint in Bulgaria for 66.5 million euros. They secured over 90 acres near Milan for 56.5 million euros. And they're buying Telco Hub 1 in Malaysia.
Yes.
What's the mechanism driving this international expansion? Why do they need to be in Bulgaria and Malaysia simultaneously?
It revolves around this concept known as data gravity.
Data gravity.
Yeah. Think of data like a planet. The larger the data set, the stronger its gravitational pull. Multinational apps and corporate divisions naturally want to orbit as close to that data as possible to reduce latency.
Okay, so if one of those 116 new enterprise customers is a global logistics firm.
Right. They have inventory data in Europe, shipping routes managed in Asia, and computing power in Atlanta. If they rent space from Digital Realty in Milan and Kuala Lumpur and Atlanta, they can route all their proprietary data across Digital Realty's closed-loop global network.
Oh, I see. So being in Malaysia makes their real estate in Atlanta exponentially more valuable.
Precisely. Because they can offer a seamless global ecosystem to the tenant.
There is also a very practical financial benefit to that global footprint hidden in the 10Q. The filings point out that their international operations are funded locally in local currencies.
Which acts as a natural operational hedge.
Exactly. Because the US dollar fluctuated against the euro, the pound, and the Singapore dollar this quarter, Digital Realty actually recorded a foreign exchange benefit in their earnings.
Yeah, if you collect rent in euros and pay your local utility bills and construction crews in euros, you aren't bleeding value in constant currency conversions.
It's a highly efficient treasury strategy. But that brings us to the most critical question for any retail investor looking at this stock. How on earth do they pay for all of this?
The billion-dollar question.
Literally. Buying 800-acre plots and outfitting them with liquid cooling requires an astronomical amount of upfront capital. How is management footing the bill without drowning the company in debt? Let's dive into the funding mechanics and the risks attached to them.
You really have to look closely at how they engineer their capital stack. Looking at the balance sheet, they are currently carrying $18.0 billion in total debt.
$18 billion. I mean, that is a staggering figure that would instantly terrify a lot of investors.
On the surface, absolutely. But in the context of their immense cash flow, it's very strictly managed. Their net debt-to-adjusted EBITDA ratio, which measures how many years it would take to pay off that debt using current earnings, sits at a very healthy 4.7 times.
Okay, that's not bad.
Right. They also maintain a fixed charge coverage ratio of 4.9 times, meaning their operating income covers their fixed debt payments nearly 5 times over.
Yeah.
So despite the aggressive expansion, they're maintaining a pretty conservative leverage profile.
However, they aren't relying solely on debt, which leads to a strategy I really want to unpack here. According to the filings, in Q1 alone, Digital Realty sold 7.3 million shares of common stock under their ATM program.
Yeah, the market program, yeah.
Right. They generated net proceeds of $1.3 billion just by issuing new stock into the open market. Look, if I'm a current shareholder, isn't that heavily diluting my ownership stake? Are they funding this 5-gigawatt expansion at the direct expense of existing investors?
That is the eternal tightrope walk of managing a publicly traded REIT. Issuing 7.3 million new shares absolutely dilutes existing shareholders. There's no way around that math.
Yeah.
But you have to consider the alternative. If they funded that $1.3 billion entirely by issuing new corporate bonds, their leverage ratio would spike dangerously above that safe 4.7 mark.
Which could trigger credit rating downgrades.
Exactly. And that would instantly make all future borrowing significantly more expensive. Equity issuance acts as the necessary pressure valve that keeps the balance sheet pristine while still capturing this historic AI demand.
But they can't simply print new shares forever, right? At some point, the dilution becomes too much of a drag on the stock price.
Which is exactly why they are heavily utilizing strategic joint ventures to shoulder the capital burden.
Hmm.
This quarter, they highlighted the launch of the Digital Realty DC Partners NA Fund. They successfully secured over $3 billion in equity commitments from outside investors for this specific fund.
How does a joint venture like that actually function? Do they just, sell the data centers to the fund and walk away?
Not at all. It's a brilliant mechanism for capital recycling. Digital Realty retains a 20% ownership stake in the underlying assets within the fund.
Okay.
And crucially, they continue to serve as the general partner, so they retain all the operational leasing and management responsibilities.
Oh, I see. So they continue to collect management fees, they maintain control of the network ecosystem, but they successfully offload 80% of the upfront construction costs to outside institutions.
Exactly. It lets them aggressively build out those gigawatt campuses without absorbing all the financial risk and all the debt onto their own balance sheet.
That is really smart. But even with brilliant capital recycling, building infrastructure at this scale is inherently risky. The risk factor section of their 10Q reads like a checklist for a logistical nightmare. When you parsed through those SEC disclosures, what stood out as the biggest threat?
The intersection of supply chain bottlenecks and inflation is definitely the most potent risk they face.
Really? More than demand drying up.
Oh, absolutely. Building a modern data center requires highly specialized equipment, industrial liquid chillers, massive backup generators, custom switchgear. These components have incredibly long lead times. If a shipping route is disrupted or a manufacturing facility in Asia goes offline, construction on an entire campus just halts.
And a delay in construction directly exacerbates the inflation trap, right? We talked about that 19-month lag acting as a shock absorber, but it's a double-edged sword.
It really is.
Imagine signing a contract today with a hyperscaler, locking in the rental price. But you don't actually purchase the steel, the concrete, and the copper wiring for another 12 months.
Yep.
If macro inflation causes raw material costs to spike during that window, your building costs skyrocket, but your rental income is already locked in. The profit margin could be entirely wiped out before the tenant even moves in.
Which ties perfectly into the second major risk factor,
Right.
utility delays. We discussed buying 873 acres in Atlanta to secure access to the grid.
Right.
But what happens if the local utility company faces its own supply chain issues? If the utility says, hey, we can't get the high voltage substation built for another 3 years, that 19-month backlog suddenly stretches into a 36-month delay.
Wow.
The revenue gets pushed further into the future, but your capital is already sunk into the land. Management is executing an exceptional strategy, but they're operating in an environment fraught with severe physical constraints.
So let's pull all of these threads together. Digital Realty is capturing an extraordinary wave of demand, driven by the global explosion of AI and cloud infrastructure. We see the definitive proof in their record bookings and that staggering $1.8 billion backlog, which acts as a multi-year shield of future revenue.
Yeah.
They're driving profitability through the sticky, interconnected tenants in the 0 to 1 megawatt reef, while simultaneously securing vast tracts of land globally to build gigawatt campuses for the whales.
And funding it all through a really careful mix of debt, ATM equity, and joint ventures.
Exactly. They are quite literally constructing the physical foundation of the next technological era, balancing the insatiable demand of the digital world against the hard, uncompromising limits of the physical world.
That's a great way to summarize it.
As we wrap up this deep dive, I want to leave you with a final thought to mull over. We discussed Digital Realty acquiring that 873-acre plot in Atlanta to construct a 1 gigawatt data center campus. To put that into perspective, 1 gigawatt is roughly the equivalent of the power generated by a nuclear reactor, or the total electricity required to run a medium-sized city.
It's massive.
As these sprawling AI-driven hyperscale campuses continue to come online across the US, Europe, and Asia, how will our local aging power grids adapt? Will the next major bottleneck for the entire digital economy not be a shortage of real estate or advanced chips or investment capital, but simply the raw physical limits of our global electricity generation?
It's a huge question.
Something to think about the next time you ask an AI to generate an image or summarize a document. Thank you for joining us for this deep dive. Make sure you follow the show for our daily earnings coverage where we break down the underlying mechanics shaping the market. See you next time.